Hi everyone, welcome to another Learn, Grow, Invest meeting. It is a pleasure to have another one of these meetings. I do not take this for granted. I welcome everyone who is joining us for the very first time. For those who are regulars, it's good to see you again. Let me know that you're here by just typing your name in the chat, and we're just going to jump right into this. So I'm going to open with a word of prayer as we normally do, and then I'm going to talk a little bit about the topic I'm going to cover today. So let us pray. Lord, we thank you so much for this day and the opportunity to meet as investors to discuss these topics that will help us learn and grow. Father, I pray that when this topic is shared, it will impact our knowledge, our wisdom, and our ability to invest successfully. I pray your presence be here with us in Jesus' name. Amen. All right. Hey, Dane, welcome. So I'm just going to jump right into this. So this is going to build on the topic that we covered last week. If you didn't see that video, I'll link it in the description below. But last week we spoke about how many stocks you should actually have as an investor. We spoke about two topics, concentration versus diversification. If you're not familiar with those concepts, check out that video immediately after this one. This one is not dependent on that one, but I did mention this topic in the last meeting. So just understand that there are things that we'll speak about in this one that will build on the previous one, but it can stand on its own. So for this one, we'll be talking about the concept of portfolio rebalancing. So I want you guys to let me know in the chat if you've heard about that before. Have you heard about portfolio balancing before? Do you balance your portfolio now? Do you understand what that concept means? Let me know in the chat. And I'm just going to share my screen. And so there are a couple of things to understand about portfolio rebalancing. It's actually a healthy part of managing a portfolio. And when I say portfolio here, I'm not just talking about stocks. So I know a fair amount of our community are stockholders, investors in the stock market, but this principle can apply to all assets, right? So you can actually rebalance a portfolio that includes real estate, stocks, cryptocurrency, other forms of assets that you can invest in. You can rebalance that portfolio. So that's what I'll show you a little bit today. I'll use examples from stocks, but understand the principles that I'll be showing you here build on all of that. So it works for all assets. All right. So portfolio rebalancing is about limiting exposure. So if you think about investing, if you think about, let's say you're only invested in stocks, you could be told, or you could see where persons may say you're prone to volatility. The stock market, though it's known to be one of the best, if not the best, sources of returns for an investor, it also presents one of the most volatile, arenas in terms of investing. Now, in terms of a portfolio rebalancing, what that does, it limits the exposure both on a portfolio level. So if it is that you rebalance a portfolio of stocks, you may limit your exposure to various types of stocks based on the industry, based on whatever that company may be available to in terms of risk, because each company within the stock market is prone to risk in terms of industry, competition, other factors that can affect it. So we saw with COVID where, for example, with the restrictions that we had, if a company that's for example in entertainment, the risk that would be for them to be able to successfully grow their business during a pandemic would be higher than a business that maybe sold goods online. So there's a certain amount of risk inherent in every form of investing, stocks included, and portfolio rebalancing allows you to manage that risk, right? So it can be done on an asset level or a stock level. So I'll show you what that looks like very soon. Main thing to remember here is there are two types of portfolio rebalancing. There's actually three types, but I wanted to keep it simple. I won't mention the third at all until I've built on some other concepts first. But there are two ways to rebalance. We can do it based on when we get to a certain percentage of our portfolio, or we can do it at a specific time interval. So what that means is that I can rebalance my portfolio every 30 days, every 60 days, every 6 months, every 2 years, every 5 years, so on and so forth. Personally, what I do is rebalance my portfolio every year. So those persons are part of the Learn, Grow, Invest community. In our group, they'll hear me talk about me rebalancing my portfolio every January. So what I would do is look at how my stocks would have performed over the past year. Then in January, I determine which stocks I'm going to keep, and I'll walk you through that process, right? But I do mine every January. It's not to say you have to do it January. It's just that time that I've chosen. It's a time that I think, you know, starting a new calendar year, it makes sense for me to have that focus or narrowed projection on the year. I know persons who rebalance every quarter. I know persons who rebalance every 6 months. I know persons who rebalance based on percentages as well. So I'll explain what both look like. So why should you rebalance your portfolio, right? Why should you listen to this video, watch this video, try to understand the concept that I'm showing you here? It's because you want to limit, as I said, that exposure. So you may not have thought about this before, but the companies in your portfolio, the assets in your portfolio now, you can be overexposed or underexposed. So let me explain what I mean. In a very simple term, when you're overexposed, it means that, as we mentioned last week, you may be overweighted in that particular stock. So if your portfolio is valued at $1,000 and you have two stocks, one is valued $900, one is $100, you are overexposed to the risk of the company that's valued $900, because if that asset goes down by 50%, so 900 down by 50%, that's 450, your entire portfolio is now down to 550, which is 45%, as opposed to if you had 50-50. So if you had two stocks, one valued $500, the other $500, one goes down by 50%, your portfolio is now $750, right? So I hope you guys got that. So it limits that over or under exposure, because the opposite is also true. You can be underexposed based on what your risk profile is. So if you are, so some persons are part of our community are moderately aggressive. If you're moderately aggressive, it means you're comfortable taking a certain amount of risk, which means you should be investing in a certain type of asset. And you know, because of an imbalance, can be underexposed to certain asset classes that would match your risk profile, right? Hopefully that made sense. Let me know if you have any question in the comments below, right? So it's a healthy part of good portfolio management. I do it. I know persons who do it as well. It is something that it is not an exact science. You have to understand that it is based on personal preference. What I'm hoping to do is give you a framework around it for you to just kind of understand how you can implement this yourself. All right. So there are some things you want to consider, and everything that we share here at Learn, Grow, Invest, context is always important. So it's never blanket, you know, advice, or, well, it's not advice in general. It's not blanket information, but it's information within a certain context that you can apply to your situation, understanding your profile, and speaking to those who are legally entitled to give financial advice, and you make your decision, right? So everything that I'm sharing with you now, it's just an information for you to process and determine if it makes sense for you to employ. So the factors you want to think about before you rebalance or consider in that process is you want to identify your target asset allocation, right? That's the first thing. So think about this. What does this mean? So I said, so what I said last week is that there's typically, so let's say that there's some portfolio or risk profile questionnaires that will say, okay, if you're 40 years old, minus your age from 110, and that's the amount that you should have weighted in stocks. So if we use an example of somebody being 40, their portfolio is weighted 70% in stocks. That would be considered their target asset allocation. So you can let a questionnaire determine that for you based on best practice, or you can determine what that should be yourself. So you could say, and most persons when they're starting out in terms of investing, they start with stocks. So typically most persons, well, some persons on this meeting now could be 100% in stocks, right? And then you can know if you're only holding stocks, and let me know this in the comment below, what's in your portfolio. Are you holding just stocks? Do you have real estate? Do you have maybe some cash in your portfolio? What's in your portfolio without telling me the asset, of course. Tell me what's in your portfolio. So don't tell me which stock, for example, but you can say I have stocks, I have real estate, I have cash, etc. Right? So you want to consider that. Next, you want to consider how you want to do your rebalancing. You can do it yearly, as I said, or you can do it based on a percentage of the asset allocation that you have. Next, you want to determine how you want to treat. So if it's stocks, do you want to reinvest your dividends? Because if you do, that will impact the weighting of the asset as compounding takes place. Because if you reinvest your dividends, when you get them, essentially the weighting of that asset will change over time. So if you have a stock and you get 3% dividends every year or every quarter for the next 5-10 years, you will have more units of stock than you started out with, right? And that's just how it works. That's what people say when they say you're compounding. You are reinvesting in the asset, and so your returns are greater because you keep reinvesting in the asset, right? And the next thing that you want to do is consider how much cash you're going to add. So our portfolios are never static. We may start with a portfolio worth $1,000. We add $100 each month. At the end of the first year, that's a 2,200 portfolio in terms of cash added, and that's before any capital gains or price appreciation or depreciation. So you want to check to see the cash that you're adding and understand the impact that this will have on you wanting to rebalance or maintain a certain balance, right? All right, so this is a sample portfolio, right? And so let's say this is, I went into a broker and I say to them, I have $2 million. I want you to create for me a portfolio that meets my risk profile. So if you look to the right of the screen, I have there some target allocations based on what I agreed with my advisor. So my advisor says, based on your risk profile, Jermaine, these 4 stocks are what I recommend. And, this is the weighting that I think that we should take. So they say, okay, 45% in stock A, it's priced a little higher, but it's a solid company. And since you're maybe a conservative person, you want to choose a good blue chip company. So stock A meets that criteria. So we're going to put 45% of your cash into that stock. So I take up $900,000. I buy 6,272 units of stock A. And then I do the same for stock B. I spend 505,600. And you notice it's not an equal thing on the portfolio percentage, because typically when you have fees and other things, it's not going to be an exact number, right? So I just wanted to make that a very real example. And then I bought another stock, 375,000 units. That value is that. So if you notice where it shows portfolio percentage, I have close to the target allocation, right? So this is my initial portfolio that I have, right? So January 1st, this is my portfolio. So what are some of the things that are likely to happen here? Well, naturally, the prices will change throughout the year. I may decide to take profit on some stocks depending on how the value increases. Many things could happen. I could be hit, COVID could come out and now these prices might have dropped. And what will happen in that case is these allocation percentages will change, right? So if you look at this slide, for example, so this would be the allocation at the start, January 1st, initial allocation. This is what my portfolio looks like: stock A, stock B, stock C, stock D. But after a few months in now, this is what my portfolio could look like. So for stock A, the price went up from what it was before. It's now $230. For stock B, price has gone up. Stock C, it's just blown up. I never really expected it to go from $1.33 to $4. And stock D has actually gone down. So this is what your portfolio may look like after 3 months, after 6 months. But if you notice, your target allocation that you had at the start, it's no longer anywhere near those targets except for maybe stock B. So stock B is kind of, hovering around the same thing. But if you notice, for stock A, stock C, stock D, they're outside of their target allocations, right? So think about if this continues. So if stock A continues to rise, remember what I said on the first slide, I may start to become overexposed to stock A or overexposed. So let's say stock C goes to $10, which is a problem we'd all love to have, right? We'd love it if all of our stocks go up. But we know and understand that not all stocks go up at the same pace at the same time. So as it goes up, the weightings will change. And that's why you rebalance, right? So this, for more impactful example, this is what the weightings now look like. So stock D, if it went any lower, you'd almost not even know it's in your portfolio at all. Stock A, stock B, stock C is there. So if you think about this, this is definitely a portfolio that you'd understand would need to be rebalanced, because you're now overexposed, underexposed in terms of stock D, and your portfolio is not being managed well, right? So what are some of the things that you can do? So there are two key ways I'll show you to rebalance here today. And as I said, we're keeping it to 2 because it's just simpler that way. So the first thing you can do is sell the stocks that are above the target allocation, right? And you may wonder, well, how does that make sense? Because you hear, don't sell your winners, add to your winners, and you're good. That's not necessarily true. Everything in context. Every piece of investment advice you hear should always be in context, right? I don't believe in blanket statements personally, right? So and we can get into other discussions about that, right? One way to rebalance is to sell the stocks that are above the target allocation, right? The next thing that you can do is you can use cash to increase the stocks that are below allocation, right? So what this means is that I can take cash, because every month, if I'm getting a salary or I get cash from jobs or projects that I work on, I may have a certain amount of my portfolio each month that I invest, right? So I can use cash each month to put it in the stocks that are now underweight or underexposed and build back up that allocation, right? So two key ways. So remember what I was saying before, there are 2 ways or 2 types of rebalancing that you can focus on. One is the percentage. So if you looked at it before, and let me go back a couple of slides to show you, if we use the percentage option, I can say, well, stock C, which was supposed to be 25%, is 38%. So because I could set a threshold to say, if my target weight is 25%, I can rebalance if it passes 35%. Because it's impractical to rebalance every time it moves from 25%, because you'll be rebalancing probably daily. So you rebalance when it's at a certain threshold, and you can say, well, if this is at now 35%, I can either rebalance by adding cash into something else, or by selling and taking profit off the one that it's up 38%. Now, I hear Chike asking me, because Chike is a person from our group who wants to see that stock go up 1,000%, 2,000%. This is not preventing you from achieving that. But remember, you're trying to get to a target allocation based on the exposure or the risk you want to take. Now, if it is that you are comfortable, or that particular stock being weighted 38% is not a bad thing for you, then maybe you want to change what those target allocations are in the first place. Because if it's at 40% and you don't wish to sell it or change from that exposure, then maybe 25% didn't make sense to start, right? So this does not prevent you from getting the stock to 1,000%. What it does is it limits your exposure, because when the value of the stock increases, the amount that you have to lose in terms of value increases as well. So if you think about it, if the stock, let me go back to that screen to show you. If stock if stock C goes up to $10, right? If it goes to $10, then the value of the portfolio would be over 50% weighted in stock C when I wanted it to be 25%. That puts me at a risk now in case that stock maybe has a bad few months, or there's something that affects that industry. I risk losing that value. Whereas if it went to $10 and I rebalanced and put the money, let's say in stock D or in stock A, I preserve the value of my portfolio by shifting the cash to another asset. So the value of the portfolio is more or less maintained, and you will see gradual growth that way, and you're less likely to see fluctuations in terms of the volatility of the market affecting the value of your portfolio. Right, so I hope all of this is making sense. Let me know if you have questions in the comments, right? So I went through this. So this is the percentage portfolio. There's also the periodic adjustment. So as I said, what I do, this is not what I'm telling you to do, but you can determine what works for you. I rebalance my portfolio every January. And that's because at the start of the year, typically there are persons saying, this is the outlook for the year. This year is gonna bring these changes may come around tax time. They're typically companies around that would share their vision for the year or the economic outlook for the year, and those things I factor into my decision to keep certain stocks, add to certain stocks, or to take profit. Because depending on the outlook for a company I have in my portfolio, I may say, let me take profit from this stock to now add to my position at a later date. Because think about it this way, and this again is an example that I've shared with Chike from our team. If a stock is on a good run, right, great momentum, is picking up on price, doing really well, it's okay to take profit from that stock. And if there is a correction, to re-enter that position. So if you have 100 units and it's valued at $1,000 and it gets to $1,500 and it's the same number of units, but you take profit, when the price lowers, you can add to your position again at a lower price because you'd have taken profit higher. So you can ultimately end up with more units. Hopefully that made sense, right? All right, so last week I shared this example of a diversified portfolio in terms of stocks, cash, real estate, bonds, all of that stuff. So this portfolio can be rebalanced as well. So you see in this one, we're large cap stocks, 28%, small cap, 18%. You can rebalance this portfolio as needed. Because let's say you have real estate that has gone up 25% in value. So if you have a $1 million house that's now 1.5 million, that would shift the weighting of this portfolio. So it may require you to rebalance. All right. So the steps to rebalancing, very, very simple. And I'll get to a working demo soon, so you see what it looks like. You want to assess your risk profile. You definitely want to know that before you make any investment decision. Know your risk profile. If you don't know how to determine your risk profile, we did a video on this, so just search the video section of this channel, and you'll be able to see a video called Understanding Risk Profiles. Watch that video, take the questionnaire, and you'll understand what type of investor you are from that risk profile. You want to identify your target allocations. You want to track your stocks. So I use Excel. I've built my portfolio. I manage my entire portfolio of assets, so stocks, real estate, cash, cryptocurrency, forex, all of that stuff in Excel. But there are apps to do the same or websites to do the same. You want to select the appropriate strategy that applies to that portfolio that you want to rebalance. So there's strategies within strategies, and I'll talk about some of that a little later. And then, of course, with every plan, you want to update it as needed. All right. All right. So I'm going to get to the example in Excel. So are there any questions? Let me just see what some of the questions may be. All right. Why rebalance only once a year when things are constantly changing? That's a question from Carrie. So I rebalance once per year because I understand in dealing with stocks, there's a certain amount of volatility. So I'm not necessarily concerned so I can take profit from a stock without rebalancing the entire portfolio, right? So there are levels to it, and I'll show you in a sec here. I'll answer that question. But for me, there are fluctuations every time with stocks, especially real estate doesn't move as much. Cryptocurrency. Imagine trying to rebalance a cryptocurrency portfolio. That's to do that daily. I couldn't manage that. So let me show you what the Excel example looks like. So I'm going to stop sharing. One sec. Let me stop sharing that presentation. So disclaimer before I share this, this is not my portfolio. So do not think that the portfolio I'm showing you is mine, okay? This is just for demonstration purposes, all right? So let me know if you guys can see the screen okay. So this is, let's say that this is my portfolio, right? So I have investments, I have some real estate, I have, well, let's call this as just a stock, that's just easier. I have some cash, everything has a value here, and I have an overall value that's here of 5 million, right? All of this makes up 100% of my portfolio. I can have target allocations for these overall assets. So remember, I say you can do rebalancing on an asset level. So I can say I want to have 10% in crypto, 20% in terms of my real estate, 50% in stocks, and I want to have 20% in cash. So I like to have a target allocation for cash because that helps me understand if I'm deploying my cash well. So if I have 31% of my portfolio in cash, I may say in this case, well, it means I have 11% of my cash that I can put in some other asset that is down to build it up, right? So I can put 11% of this cash into stocks because stocks is 34% of my portfolio when my target is 50, right? And what I have here on these sheets are yeah, don't worry, we'll be discussing crypto soon. Give us a couple of weeks. Let's say I do a valuation on equity on the real estate. It's 1 million. You see that here. This is a stock portfolio. This is the same image that I showed you on the slide. This was the initial allocation. And then this is my sample crypto portfolio. So I bought 0.1 unit of of Bitcoin. I bought 5,000 units of XRP, I bought 5 ETH, and these are just prices. I don't know if this is the actual price. I think Ethereum is like maybe $1,700 now, if I'm not mistaken. So let me change that. And as you notice, once I change the price, it changes the value, which impacts this overall value here. Right, so this one changed to 27% based on the fact that it's linked on this sheet. So I hope you guys are following me, right? And then I have my cash. So this can be my investment account, and this is my personal savings account, right? Because most people have that, right? So this is my portfolio, right? I'm just gonna show you rebalancing based on stocks only, right? But understand that the principle can be applied across the board, all right? So let's say that we gave the example that I mentioned before. So let's do a worst case first, right? Can everybody see the screen okay, by the way? Let me know if it's good to see. Let me know if I need to zoom in. Just do it just a little bit, just in case. So let's say that it's, the time is going good, stocks are doing well, and this goes to 230, and then stock B is doing well as well, good report, goes to $1. Then stock C is not really doing so hot, this one went down, and stock D, I made a great call, it's now $15, right? So you notice here a few things that have happened, right? So stock D has now doubled in terms of its target allocation. Stock C target is 25%, but I'm at 14. And stock B, went up a little bit, but because of the growth for other things, it's around 25%. But stock A, which has gone up the most, is now 45%. And you notice it's red, and that's because I've set up on this some conditional formatting to tell me if it's outside a threshold. So I can determine the thresholds that I have. So my threshold is that if it's higher than the target allocation, let me know, right? So let's say that it goes up even further. Let's say stock B is the great one for the year. I filled out I made a good bet with this one. It's now $30. You notice just by changing the value of this one is now back into target allocation. So that's why it's green, but it throws off everything else. And this is what happens every day with your portfolio. Every day the price goes up or down, your portfolio weighting goes up and down. It's just a consequence of how the market works, right? And the same can be for crypto. So this was when Bitcoin was $32,000. Now it's $56,000. So I mean, add that. So it changes the value of the portfolio, which changes the value of the assets I have overall. So this is now 26% of my portfolio when I wanted it to be 10, right? And if Bitcoin gets to 100,000, changes the value again, changes the value right here. Now it's 31%. So this is now 3 times my target allocation. So the allocations is it's all subjective. So there are best practices. I don't always subscribe to, depending on who you talk to, you may hear a different best practice for the asset. But what you want to do is determine your risk profile first, and then you can determine a target allocation. So for me, I may say, well, crypto, it's still in its early stage. It seems very volatile. I don't want it to be more than 10% of my overall portfolio. That's a personal decision. You may say 5%. Another person may say 40% because it only goes up, so we don't have to worry about it. It's very, very subjective, right? I may say, well, I want to have 20% in cash to take advantage of any IPOs. If somebody comes to me with a business opportunity, I want to have 20% of my assets in cash at all times. And if you think about it, let's say that we just explode everything here. Let's say we multiply everything by 5, right? We just put, this is 1,150, that's 5, that's 5.5, that's 150. We're multiplying everything by 5, right? That price by 5 would be 90. That price by 5, persons would love to see Bitcoin at 500,000. And this by 5 would be, I think, 85. So I'm multiplying everything by 5. My overall assets is now 36 million from 8 million. It's still going to be a relative percentage to the overall value of the portfolio. So that's why the money, the value of the portfolio in this case is not as important as your target allocation. So everything has gone up, but I can say, well, I don't want, regardless of the value of my portfolio, value of my assets, I don't want to have more than 10%, even if it's 100 million, I don't want more than 10% in crypto, because now let me show you a situation that most of us probably are aware of by now. 2017, XRP maybe went down to 10 cents. Bitcoin maybe went down to $3,000. And now this goes down to $500. And now went from it being 38% of my portfolio to it being 2%. So if I was rebalancing my portfolio when this was at 31%, if I shifted that profit into other assets, then I would not have lost all of that value. Understand what I mean? So Jess, what I recommend you do is when the video is done or when you have the time, rewatch from the start. I'm just showing a working example of what I was sharing before. So depending on the time you joined, I'm showing the example or just going through a practical working example of rebalancing your portfolio and why you'd want to rebalance it. So that's what we're talking about. So I'm just showing different scenarios that can happen from real world examples, right? Yeah, so right. So let's say we focus now on our stock portfolio only, right? Let me go back to some realistic numbers, right? Let's do $3, let's do 250. Let's do, this was 5, so let's do 10, right? So we're only going to focus the rest of the way on stocks, right? And I'm just gonna explain what I've done with this sheet, right? So I've put in my stocks here. I've entered the price of the units I have, the price I've paid, including fees. Well, this is just market value actually. This is the value, and this is simply just price by units, gives me that value. So I have cell C3 times D3 there. Then I have portfolio percentage. So I have the value here divided by the absolute value in this cell. That gives me the percentages here. And this is just me determining my target allocations for each stock. So these are manual entries. And then I've done here, I've just had a column called difference. And what I do is say, okay, if it's under my target allocation, then tell me how much value that is in terms of allocation for that stock. So this being about 11% down, that value is equivalent to 542,000. And this being up by 19% is valued 1 million. And the reason why I would want to know this personally is that I can now say, okay, I have $1 million to add to these other stocks, right? Let me show you how this works. So I take this $1 million and I say, okay, at this current price, how many units do I need to sell to take advantage of shifting this million into another asset? All right, so I want you guys to stay with me, all right? So $1 million divided by 3, that's about 333,000, right? So if I take 333,000 units from this, All right. Let me do that. I've sold $1 million worth or close to $1 million worth. I'm going to take that $1 million now and add to stock D, right? So, well, stock D may not be the best bet, but you notice I took the $1 million away and instantly brings it down from 43%. It takes me down from 43% to 32%. But now I have a couple of options here. I can add the cash equally across these or just keep it in cash. So I can add to my investment account $1 million, right? Or to be specific, I've added that $1 million here. So my assets overall in terms of cash, it's right around the 20%, which is fine. And my stocks can actually stay like this. I can just take my profit and do nothing else because everything is relatively close. Or I can say, let me take that cash and add it to my crypto portfolio. So I can say, okay, I have 0.1 units of Bitcoin. That's about $500,000. Let me add another. Let me add 0.3. Right? So let me see, did it change value here? See for yeah. Did it actually change? I didn't see it. I think it did. Okay. Right. So I can take the cash and add to another asset. And what I would have done is brought it back to a reasonable threshold. Or I can take the cash and put into another stock. All right. I hope you guys are with me now, right? Are there any questions for this step? All right, so Gavin, I can share, if you're not on social media, the best I could probably say is send us an email. Yeah, so send the email and we can forward the spreadsheet to you. It's a very simple spreadsheet though. But yeah, we can send it. So I can just decide to do that. And now a few months later, so let's say that the prices here have corrected a bit. Let's say now the market is gone down, the stock's not doing so well. That's now 200, that's now 150, that's now $2. And I can say, well, hey, this price has gone down from 300. It may be a good opportunity to buy. So I can decide to take my $1 million and buy this stock, right? So that would give me about, I think, 50,000 units. Let me see. Let me do some math here. All right, so I have $1 million. And the stock is valued 200. I can buy 5,000 units, right? So I can add now to this stock 5,000 units. And now, of course, if I added $1 million to just one stock, it would shift the weighting. So you definitely don't want to just take it from one and add it to another. You want to either dole it out, whether each month you add a few units or you build up one altogether, or you could just say, hey, maybe I want to change my threshold and just say, all right, I'm fine with this being 20% or this being at being 20 as well. So that'd be what, 90. So let's say 55. Let's say that I've changed my threshold. And so this is the new threshold that I think is reasonable. Then I can just adjust this and say, well, let me highlight the cells greater than 60%, because that's a more realistic threshold. I don't think that applied just now. Did it not apply? Okay, I'll troubleshoot that later. All right. So hopefully you get the idea what I'm saying. You can rebalance on a stock level or on an asset level. It really just depends on you. Right. So that's really all that I have to show you guys today. It's really it's a concept that you have to wrap your mind around. see what works for you. Of course, if you have more stocks, imagine if you had more stocks, this process may take you some time. You want to be sure you're tracking everything. You want to be sure that it's good to automate things. So I would say if you're entering prices manually, you may want to automate that. I can have another session where I show you how to create an automated portfolio where it tracks the price for you automatically. Let me know if you'd be interested in that, because we can build a stock tracker in a meeting, right? So we can just get the link for the stock online, connect it to Excel, and each time you open the sheet, you just hit refresh and it would update the stock price without you having to check, you know, jam StockX each day to get the price, right? So you definitely don't want to do that. The rest is just formulas and formatting. All right. So are there any questions? Okay. Okay. All right. So what I'll do for, okay, so what you can do is I'll definitely have a session to go through that. So just as we're saying in the chat, just be sure to subscribe, because we'll just, that seems like a good session to have maybe at the end of the month, or okay. So what I'll ask you guys to do, you're typing in the chat now, but below the video, I want to see how many persons would actually be interested in having us do an automated portfolio session. So below the video, I'll ask you to comment and not in the chat, because if you post it in the chat when the live ends, then I won't be able to see all the comments again. So place a comment below the video. And what we can do is you can send us an email as well to say that you'd be interested in that. And we'll just be the first to notify you when we're having that session. All right. So are there any questions otherwise before I close up? Okay. All right. So since there are no questions, so Karen, no. So you don't. So rebalancing has to be practical, right? I don't think every time you buy a stock, you need to rebalance. But if you think about it, if you add a new stock to the portfolio, then for that same set that I showed you, let me just probably go back to it quickly. If you add a new stock, what you need to do now is determine the weight that you want that stock to have, right? So let's call this stock E. Let's say about 10,000 units. What's a good stock right now? Everybody's talking about Mailpack 344, right? So you notice here, if I add a new stock, I need to now determine a target allocation. So I can look at my portfolio and say, okay, I'm comfortable with having 50% here, 15 here, 15 here, 5, and maybe 15, because I'm maybe, just maybe, I'm bullish on stock E and I want it to be 15%. So what that means is this is 34,000. For the next few months, if I add 50,000 each month, I would add to this stock only until it gets to the target allocation. All right. Lenworth, that's a very hard question to answer. I wouldn't, it's hard to know the average portfolio size. I do know that a lot of the persons I speak to, well, I speak to persons on both sides of the spectrum, actually. I know persons with $50,000 portfolio, but I know persons with 50 million portfolio. So it really depends. Yes, thank you for that feedback, Lolin. Hopefully I'm pronouncing that correctly. Well, that's so we're hoping that the community can grow and have many persons, you know, watching and sharing our content. We really rely on our community members to share the video. So we do ask you to share the video, help others to build up their knowledge as well, because if you think about it, the better we are as investors, the better the companies need to be that are trying to raise money from us. Because if we are smarter as investors, then the companies themselves have to be more intentional about their initial, offers and how they're priced and so on. So everybody benefits, right? Yeah. So when I started investing, I started with one stock, and now it's grown to a portfolio of, I think to date, I'm now at 12 stocks. So I'm working towards concentration. If you don't know what concentration is, I spoke about it last week. So I'm trying to get my portfolio under 10 stocks. So I have 12 now, and I'm just choosing the right time to sell 2 and then just further add to my current positions in the others, right? So Kerry, I hope this answers the question, right? So if I added a new stock, I just want to determine a weighting for it, I can just pull down this formula here, and then it will show me that value, right? So it is telling me to get to 15%, I need to add 553,000. So if I take 553,000 from this, and then I add it to here, 553,000, let me tell you how much that gives me. 553,000. And the stock is valued at 344, so let's say 350 with fees. Let's say I add a 158,000 units to this. All right, 53,000 units. Then you notice, right, I've added that amount. It brings me closer to the target weight that I want. And now all of them are a little bit, so it's, you see, everything is now balanced because this difference here told me what I need to add to get to my target weight. So that's how this is set up to work. All right. And this is just a chart that's based on this table. So if I wanted to filter or customize this chart, I can. It's really just like there's a lot of things that we can do, right? So we can have a session. I feel like we need to have a session on just building and managing your portfolio in Excel, and I can show you guys everything that I do in terms of that. But I manage my entire portfolio in Excel. So I have maybe 12, 14 sheets. So I track bills. Well, then you maybe need to simplify the spreadsheet, just because it should actually be helping you more than driving you crazy. So what I have is, for example, all my assets consolidated in one. So I have my assets in one, and let's say that I wanted to do a simple net worth calculation. I can say, I can call these my debts. So I can have a mortgage here. Let's say I have a mortgage of, well, the house is valued at 5 million. Let's say that my mortgage is 2 million. I can now just say, well, let me put that. Let's say I have a mortgage and a credit card. Credit card is valued at 500,000. I'm just doing some basic additions here so you guys can see how you can build out this spreadsheet if you wanted to. All right, so this is now, I'm showing my assets here, my liabilities here. So I can say, let me do, let me just hide these. And I can do a net worth equal, let's say, C8 minus 12. This can be my net worth calculator, right? So I can just have this here, and every time I want to track and see where I am in terms of my net worth, I can just look at this number. So I can set this to say, well, if it is that this net worth goes below 8 million, then I should maybe, manage my debts a little better. If I, pay off my credit card. So if my credit card balance is 0, then it impacts my net worth now. My value has gone up because I have less debt. You know, I could take some of the cash that I have here and put it on the mortgage and say, well, let's cut this down to 1.5, and my net worth goes up again. If I have a section for dividends, I can now add dividends to this and say, okay, I'm gonna add to my dividends each month. So instead of reinvesting them in the stock, I could say I could want to track this separately and say, okay, I'm gonna use this $10,000 whenever it comes up and pay off my credit card debt. I could do something like that if I wanted to. All right. So Excel, to me, is the best tool ever to do these kind of. It's great to have an app, but I get full control when I do it in Excel, right? So it's really, it takes you a little bit of time initially to set it up, but once you've set it up, then it's just really automated from there. All right. Are there any other questions? Okay, so I'm gonna wait a few more moments. If there are no other questions, then I'll just go back to just kind of recap what we spoke about so that, you know, persons who maybe joined us a little later can just kind of recap. So let me just bring that back up real quick. So I'm gonna leave you on this slide. Hopefully the clicking doesn't sound really loud. Okay, so to just kind of recap everything that I've said today, you rebalance really to limit and manage your exposure to the different assets, right? It's really important that you maintain that level of control, because you determine when you sell, you determine when you buy. And if you rebalance in the right way, now I would recommend that you don't rebalance until you understand, you've tested the impact, you've spoken to someone who is qualified to give you financial advice, and you make a decision on what's right for you in terms of what that allocation should be. So for me, stocks just represent one of many different asset classes that I own. So if I lose my stock portfolio, I said this in another meeting, if my stock portfolio is wiped out right now, goes straight down to zero, my net worth is still positive because I'm not all invested in stocks, right? So I have other assets that I rely on, right? Okay, cool, good. So you want to just kind of have that healthy perspective. Investment, or investing rather, is for the long term. You want to think about the different market conditions that will apply. So as much as the stock market can be a great source of income, it presents a great source of risk. And a lot of people, we've seen most recently, persons who would have, you know, let's say the persons who wanted to join a certain train for a stock that was doing really well recently, nobody knew why. Persons kept buying, and now there are persons trying to get their money out and are not able to unless they take a significant loss. So again, that's a perfect example, because if a stock has gone up 200% and you don't know why, and that's above your threshold in terms of allocation, perfect example to rebalance. Take that profit, put it into something else, and then you would have preserved that capital, that profit, to now invest in something else. All right. Okay. All right. So I want to thank you guys for watching. Thank you for being a part of this community. We really do enjoy the discussions. We like how things are going in the Facebook group. If you're not with us on Facebook, please, you know, search for Learn, Grow, Invest on Facebook and join that Facebook group. We have 149 persons in that group right now. Feel free to ask us your questions and, you know, share your feedback on the videos. Please comment on the video, you know, subscribe to the channel if you haven't done so yet. We do have a lot of interesting episodes to come. I have a lot of things that I want to share with you guys. I'm trying to pace it. Thank you, Francine. Thank you, Nisha. That means a lot to me, right? Because one of the things I'm trying to determine is, for everything that I think about as an investor, I'm not sure if everyone is interested in the same things that I'm interested in. So when we plan these meetings, these feedback that you're giving me now helps me to determine whether or not more sessions like this would be needed. So in my mind, I like to know how things work. I like to understand things. So that's why we don't have 5-minute videos, because to explain it in a way that is practical to you, it takes an hour, right? So that's why we don't have 5-minute videos now. We will have some of those coming out soon, but we believe these sessions, these meetings are very, very important, because as investors, we want to be more informed to make better decisions. So thank you guys for this feedback. Really, really good. I wanted to place feedback underneath the video as well, so that when persons come and see it, they're not seeing just an empty comment section. So please place some of these comments below the video as well. Please like the video and subscribe, share it with a friend. We're gonna be back next week, Thursday, with our rent versus buy conversation. That is one you definitely want to see, because it's an interesting discussion about whether or not it makes sense to rent or buy real estate. You may think you know the answer, but again, join us for the discussion and we'll see what the outcome is. And yeah, so we here at Learn Grow Invest really do care about our mission. We care about the fact that we are doing all of this because we believe that we're led to do it. We believe the Lord has inspired us to start this channel. And so for those of you who are new, that's why we open in prayer. That's why we share as much as we can about our faith, so that persons see that even as Christians we can be as much interested in investment as the rest of the world, but it doesn't mean that it has to take up our entire lives in a way that we're pursuing it as opposed to something else. So yes, Chike, definitely looking forward to it. So yeah, thank you guys for joining. I know it feels short tonight for those of our regulars, but yeah, that's all we have for today. So we'll see you next week.